This chart shows the Nifty IT index over the last 18 months, and it captures a massive evaporation of wealth. In under 2 years, India's top 10 IT companies lost 19 lakh crore in market capitalization. Looking at this isolated trend line for Tata Consultancy Services, the damage becomes even more concrete. A company that recently held a peak valuation of 16 lakh crore is now sitting at roughly 7 lakh crore. It lost more than half its value in less than 24 months. The IT sector accounts for 7 to 8% of India's entire GDP. This capital is what funded the modern skylines, real estate markets, and consumer economies of cities like Pune, Hyderabad, and Gurkhan. When an industry of this size loses a third of its value, we are not looking at a routine market correction. We are watching India's most reliable economic engine stall out. To understand what is breaking today, we have to look at the business model that built this sector over the last 25 years. It was built entirely on human scale. This graphic illustrates the core outsourcing equation. Western companies hand over routine, repetitive coding and maintenance tasks. The Indian IT firm assigns a massive team, say 10 engineers, billing for 1,000 hours of work at a fixed hourly rate. The math is simple. Profitability relies on throwing large numbers of people at repetitive problems and billing for their time. That reliable equation is now cracking under 3 distinct pressures. The first pressure comes directly from the United States government. Facing domestic pressures regarding unemployment, U.S. policymakers began threatening tariffs on offshore labor and removing crucial income tax deductions for companies outsourcing their tech work. Suddenly, American clients realized their offshore expenses might no longer be tax-deductible. In response, these U.S. companies quietly delayed or canceled their non-essential routine IT projects. External protectionism created the very first cracks in a pipeline that Indian IT firms had relied on for decades. But the second fracture we are seeing is entirely structural. Silicon Valley AI startups are rapidly deploying language models designed to automate the exact repetitive, routine tasks that Indian outsourcing firms built their empires on. This diagram shows the new reality. That 1,000-hour job requiring 10 engineers, now an AI model can execute the same workload in 10 hours, requiring only a single human overseer to verify the output. The financial markets understand this math. In the month that Anthropic announced a major new automation model, the Nifty IT index dropped 21%. Western institutional giants are already reacting to this. Accenture, a company that doubles TCS in revenue, recently lowered its future growth forecasts to the low single digits, citing the structural shift. Artificial intelligence does not act like a normal software update. It actively destroys the billing hours model that sustains massed human tech labor. So, knowing this threat has been building for years, how are Indian IT leaders deploying their capital to adapt? This bar chart compares strategic acquisitions over the last 5 years. While Accenture bought 204 different companies to absorb new AI talent and technology, Wipro bought 15, Infosys bought 10, TCS bought exactly 1. The internal data is equally bleak. If you look at this breakdown of total revenue, Indian IT companies are spending around 1% on research and development. The capital isn't missing, it is just being routed elsewhere. As this graphic shows, over the same 5-year period, these companies paid out over 4 lakh crore in dividends. Rather than acquiring AI startups, retraining their engineers, or building proprietary tech, leadership is handing the cash back to legacy founders and shareholders. They are choosing to harvest their historical profits and quietly surrender, rather than invest the capital required to survive the next decade. The market has repriced the Indian IT sector because the math no longer works. The 25-year-old foundational model is structurally damaged, and these companies are simply milking their legacy contracts. Right now, no financial analyst can define what the replacement business model looks like, or predict how severe the coming job losses will be. For retail investors, navigating this structural uncertainty requires strict, unemotional risk management. If you are determined to hold these assets, limit your portfolio exposure to under 5%. If you are heavily overleveraged in these stocks, you need to evaluate taking the loss and securing your remaining capital. There is only one metric that matters now. Do not look for a turnaround until you see a sustained spike in R&D spending and aggressive tech acquisitions from these firms. Until Indian IT companies prove they are willing to spend their war chests building the past rather than cashing out the past, this sector remains a falling knife.